Good morning, everyone. My name is Rishabh. I head brand and content for Cube Wealth, and I'd like to welcome all of you to Cube's third Know Your Assets and Advisors session. For those of you who are new to Cube, let me start by telling you that Cube Wealth is an investment app focused on busy professionals. Speaking to thousands of professionals, we found that investments are daunting to many, especially identifying the right investment options and finding top-tier advisors. That's why on Cube, we get curated investment options handpicked by expert advisors with a proven track record. Essentially, the kind of advice that was earlier only available to HNIs and ultra HNIs, Cube now helps you build a portfolio that's perfect for your financial goals and aims to offer the kind of stress-free and jargon-free investment experience that we would want for ourselves and our families. By installing Cube, you've joined people from over 10 countries and 100 plus cities. This includes founders and working professionals from brands like Amazon, Google, Cars24, Swiggy, etc. Those of you who've attended our previous sessions know that the goal of these KYA sessions is to help all of you learn about the options offered on the Cube app so you can make informed investment decisions. In today's sessions, we're going to talk about loans via merchants by Liquiloans, which is now the world's first CRISIL rated and RBI regulated P2P NBFC. To help you understand what that means and how this investment option works, we have Liquiloans Founding Member Aagam Maniar, who has a decade of experience in the wealth management space, having worked with brands like IIFL and JM Financial in the past. Along with them, we have Cube's Head of Business, Gaurav Gupta, who will post some of the most commonly asked questions users pose to us about Liquiloans and this industry in general. As always, we will always also have a short Q&A session towards the end, where you can send in your questions via chat to the host, which is me or Gaurav, and we'll have, unless we've already covered them, we'll address them. So let's get started. Over to you, Aagam.
Great. Thank you, Rishabh, for introducing me. Good morning, one and all. Thank you for joining on this call today. I'm Aagam Maniar. I'm the co-founder at Liquiloans. Before we get started on Liquiloans, first of all, would like to thank you for giving us an opportunity and being our partners for the last 3.5 years. One of the first guys who identified Liquiloans as a safe fixed income investment option, tried and tested it with their personal monies, did their requisite due diligence, and then onboarded our offering on their platform. Thankful to them. First of all, we want to also thank Gaurav, Satyen, and the whole team for giving this opportunity and helping us reach out to you all to give you better insights on how we have created India's safest fixed income investment portfolio. Right. If you want, I can quickly share my screen and also run you through some details about what is Liquiloans, right? And Gaurav can surely check with me on any specific aspect that he wants me to highlight, and more than happy to touch based upon that. So we are India's first and surely the world's first credit-rated peer-to-peer NBFC. We got our rating done from CRISIL, right? And the journey for Liquiloans was very fair and simple, where we said that we are the first, one of the first guys to enter P2P in 2018. Although P2P as a segment was started in the country by our peers in early 2012, but the industry never took up because of a lot of challenges. Post which in 2018, the RBI recognized this segment as a lucrative segment, and then they offered licensing for anybody who wanted to do peer-to-peer, right? So my promoter co-founders Gautam and Achal early in the day moved out of Rento Mojo back then, which is an 800 crore company, started Liquiloans, acquired a NBFC peer-to-peer license, quickly taking into Gautam and Achal's credentials. So Gautam has worked in IIFL Wealth. He was a founder at Rento Mojo. He's an AMCAL and a CFA charter holder. Same with Achal, again, his school friend. He was working as well in HSBC, Citibank, ICICI. He's done his PGDM from NMIMS, and he's also a qualified CFA. Both of them, along with another gentleman, co-founded a company called Rento Mojo in early 2015, which is currently valued at more than $100 million. Raised good enough equity capital from Axel, IDG, and Bain. Axel is one of the largest investors in Flipkart, Facebook, right? And did a business which was unique to the Indian ecosystem, where they were lending out furniture and appliances. They are India's largest at the moment, right? Where they raised a lot of capital, not just from diluting equity, but also raised enough and more capital from large HNIs from Barclays Wealth Management. Raised that capital, converted them into assets, and in that process, that assets got leased out to various individuals in the country. In that process, they met Renaud Deplanche, who's the largest peer-to-peer firm CEO, where he became an investor in Entomoja in his angel capacity, and he advised them to start something like Liquiloans, which will help investors essentially get a pure fixed income safe investment option, and on the other end, get prime borrowers who can get much cheaper cost of capital versus the traditional setup, right? Again, quickly running you through the core management team. Neeraj heads our credit. Neeraj essentially was a senior director in the world's largest peer-to-peer firm called Lending Club for more than 3 years. Prior to that, he was working with Capital One for more than 4 years in the risk underwriting team. He is an IIT Guwahati, IIM Calcutta chap. This is me, Aagam. I've been working with IIFL and GM. Then Ravi essentially state head of HDFC Life, has done his BA from Nagpur. And Vishal, essentially a Carnegie Mellon chap, a DJ Sangvi pass out, has worked in Infosys as well as Citadel, which is one of the largest hedge funds in the world, right? Strong core team for helping build Liquiloans early in the day. And again, when we started our journey, Metrics partners essentially backed us. Metrics is one of the largest and the biggest angel or seed fund company, which has invested into Ola Island, Quicker, Pay, 5-star, Countryside, Fiji, M-Swipe, more than 75 large investments, and they've meaningfully helped a lot of startups build a moat early in the day by giving them good equity financing. So Matrix was our seed investor. They gave us $2 million in 2018, post which we also got a lot of HNIs on our platform as angel investors. So I'm sure a lot of you would know Kunal Shah. He's currently the CEO of Cred and ex-CEO of Recharge, which he sold out for $450 million. We got Mr. Abhishek Dalmia. Abhishek ji is the chairman of Renaissance Group, part of Dalmia Bharat family. So he also came on board. We got Mr. Ashutosh Taparia, who sold his business to Mylan for $750 million. So in 2016, India's largest individual income taxpayer was not even a Tata, Birla or Ambani. It was Mr. Ashutosh Taparia. And then we got Mr. Satya Bansal, who's the ex-CEO of Barclays Wealth India, who's had an illustrious career for more than a decade or two just with Barclays. And then on the advisory board, we have Mr. S. Ganesh Kumar, ex-CGM of our ITR, RBI. And we also have Mr. Ajit Mittal, who was also working in the RBI and now is an executive director at the India Bulls Group, right? Quickly running you through the credit rating piece, where, as I said, no company on the peer-to-peer side, domestically or internationally, had ever got a credit rating done, right? It was the first time that we wanted to bring that trust and transparency in the ecosystem. We reached out to CRISIL Ratings, gave them a mandate, and they were also befuddled that they had no pre-existing formats of how do you rate a peer-to-peer NBFC. Thankfully, after a load of discussions, they came out saying that we are better off giving you an estimated credit loss report rather than just an alphabet-based rating. And then eventually they also opine on the total originations done since inception till March 2021, which also accounts for the pandemic performance, right? Where these are the numbers that they put out on the report, where we have disbursed more than 378 crores as on 31st March. Currently, the value is more than 500 crores. Weighted average IRRs there were 32% plus. CIBIL score of all the borrowers that we got on the platform was 750, right? One of the top quartile in the quality of the borrowers that we sourced. Average salary of these borrowers are 8 to 10 lakh rupees. Very low leverage of these borrowers. If they were earning $100, they were only spending 35 rupees, balance 65 at all points of time they were saving. And we got all of these good quality borrowers to our demand partners, which are more than 150 plus anywhere, and all of these having anywhere between 20 to 100 outlets, showrooms, clinics, etc. And CRISIL also said the estimated loss on such brilliant portfolio in the worst case will be not more than 1.62%, right? So that essentially gave a lot of comfort to investors. Gaurav, if you have any questions, they're happy to discuss and delve deeper.
Yeah, sure, Aagam. I'll go through the list of questions as well as, good morning, everyone. Hope all of you are doing well. The third KYA session, excited to, continue this specific knowledge series. Thanks, Aagam, for this introduction. And definitely congratulations on becoming first P2P firm to get CIBIL rating. It's a terrific achievement. Yeah, sure. We are very, very closely working with you guys. So we understand the, the achievement part, and definitely it's a great milestone. See, Liquiloans has always been one of the, one of the alternative assets which has seen one of the highest adoption on Cube app, right? Users have definitely appreciated the simplicity of the offers, or the variety in tenures, right? Whether it's a no lock-in scheme to 3 months, 6 months, 12 months, you have continuously innovated to bring in more options. But most importantly, the consistency of the returns and the high returns, which is beating the traditional options. And thanks for designing such a product. But it's like before we personally as a user, or before our users put in more money, let's understand a little bit more about how do you evaluate risk, how does the borrower selection happens, what's the track record so far, so on and so forth. Many of these questions are from our existing users or investors who have trusted you guys in the last 2.5 odd years via Cube, and put in almost nearly 25 odd crores till date. Our risk and compliance team keep asking you tough questions, and you have been diligent to answer them with all possible earnesty and transparency. And third is we have got few questions which from the users who are there on the call right now, who have already proactively sent us few questions, right? So yeah, let's start. I mean, for sure you have covered, but in terms of, let's start with this CIBIL rating, right? What does it mean in simple words, right? How, as a layman, how do I
means
understand
that if somebody had invested, somebody like Gaurav would have invested some money, right? And if he was earning a gross return of upwards of 23-24%, but the worst case NPA that he would face, let's assume a third wave, fourth wave, fifth wave, or anything crazy on the macroeconomic side happened, what will be the max loss that you will face on that portfolio? And that CRISIL has opined is in the range of 1.6 to 2%. Currently, our gross NPAs are sub 1%. It's just 0.97% as on 31st of July, right? So CRISIL also with their theoretical models after crazy evaluation, down and done, and they said that worst case, typically the number can be in the range of 1.6 to 2%, which is in our minds a brilliant estimated credit loss, which means that even after that 2% hit, no investor will even lose a rupee of interest. And not at 2, I'm saying 6x of 2, right? At 600% more than what CRISIL has estimated. Even if that scenario plays out, no investor will lose even a rupee of interest, right? Not just capital, not even a rupee of interest, right? And that level of safety is what investors want on the fixed income side. Because not just my principal is safe, my return also has to be safe. It should surely beat inflation, right? So I should not erode my capital, and I should get the requisite liquidity. I should get the regular payouts, and that thankfully, after thorough due diligence, deep evaluation, CRISIL came and looked at each and every loan that we have disbursed since inception till March of 2021 and opined these numbers that this is the performance of the platform, this is the quality of the borrowers of the platform, this is the partner strength of the platform. They have got practically bank-like borrowers, and even if something goes awry, the NPAs are not going to be meaningfully high. And that gives crazy confidence and trust to the ecosystem of investors that we have on the platform.
Got it. Sounds great. Okay, let's first, sure, there are a lot of, honestly, there are some jargons which our users would like to understand. But before we get into the specifics, can you help us understand how does this model work? What is basically, how does P2P work, and how is, let's say, your model works? And feel free to use the supporting documents or the presentation you have.
Sure. Absolutely. So first, quickly running into what is peer-to-peer, right? Peer-to-peer is not new in India, right? We have been lending monies to one another since ages, right? Our parents, grandparents, great-great-grandparents have been always lending monies to friends, families, communities, right? But early in the day, that was considered to be safe. Returns were meaningfully higher. But what eventually happened is people started defaulting, not repaying, or delaying repayments of capital, right? And then people said, I am tired of this whole model. Because saga bhi thak jata hai and time pe paisa nahi aata. Why should I not go to a bank in NBFC and just deposit my money? They are professionals. They'll help me lend my monies to a larger set of ecosystem where I make a fixed return, right? So peer-to-peer additionally was a formal mechanism to do this with a regulatory backup, and it was online, which has a very easy interface, very low cost, predictable higher returns, and lucrative rates. So essentially, peer-to-peer started in early 2005 by a company called Zopa in the in the UK. And then various players entered in the US markets and the Chinese markets, like from Prosper, Lending Club. So Lending Club, again, essentially where Neeraj was working back then. That's the world's largest peer-to-peer firm. Annually disburses $10 billion of consumer loans. In IRA terms, that's 75,000 crores a year, right? And that's why peer-to-peer essentially flourished, especially in 2008 when the equity markets cracked. People say that I don't even want to play that volatility game. Can I just lend to good credit-worthy or borrowers, make a good, better return than what my bank was traditionally offering, right? And that's why peer-to-peer also then shaped up well in India, where a lot of platforms came in early in the day saying that we will help you lend to good prime credit-worthy borrowers, help you make a better return, and they will surely charge you a fee for it, which is their earnings, which will help them recover costs and make profits, right? So traditionally, if you look at peer-to-peer, a large new asset class which evolved for the last 15 years has considerably grown, one of the best avenues to invest money on the fixed income side, especially internationally. And then the agreement and the whole structure was very simple. Lenders would come on the platforms, give loans out to borrowers, borrowers would repay back to the lender, the platform would charge a fee, right? Typical to how you were doing that same process with a bank or an NBFC, but an online model where the intermediation of a bank and NBFC was largely reduced, right? You said you directly lend to the borrower without the help of a bank or NBFC. We will help you source good quality borrowers, thereby mitigating your risk so that the lender now starts making more returns and the borrowers can get even cheaper cost of capital. So that was basic peer-to-peer, the broader structure. In the Indian parlance, what we saw is peer-to-peer or traditional lending always suffered, right? What we saw in the past is the top banks in the country, the top lending institution, ICICI, SBI, Kotak, HDFC, and Bajaj, they have lost crazy amount of money when they were lending to corporates, right? And the same entities when they were doing retail, they had 4.5x lower NPAs when they were doing retail. And that's why everybody in the country will again love an HDFC and Bajaj Finance, because one of the lowest NPAs on their platforms and one of the best compounding machines that they've created, right? So he said inherently retail was safer. But traditionally, when you are lending, right, you are always lending to corporates via bank deposit, via a mutual fund, via an NCD. He said, can retail as a carved out exposure could be provided to Indians so that you already get one layer of safety, which is only pure retail exposure. And that essentially was the start of Liquiloans. We thought with this idea that retail is safer. Retail borrowers are inherently safer because they pay EMIs. Somebody like you and me, whenever we take a loan, we pay not just interest, but also principal back on a monthly basis. In corporate parlance, that typically never happens because in corporate loans, typically they are paying interest for a long period of time. And at the end, when they have to repay their principal, they in most cases don't even have that because their capex plans are so long. Typically setting up a factory or an industry takes 5, 7, 10, 15 years. They don't have that enough capital to pay out the bank. That's why they go in the market and refinance. But that's not the case in a retail audience. Plus, retail is massively diversified, right? And ICICI would have given a 50,000 crore to an SR in the past and lost that kind of money, right? They gave 10,000 crores to Videocon, the whole money lost, it's an NPA. Versus in retail setup, you could give that same 50,000 crores to 50 lakh people, crazy level of diversification, shorter tenure loans, smaller ticket sizes, helping you make a safer exposure and a better return. And that's essentially was a quick shot on peer-to-peer and how that model evolved, and that is where we wanted to place ourselves. Quickly then, what do we do, right? I'm sure this is a question that everybody wants to ask. Why are you different? What are you doing uniquely for us, right? We said inherently, when you are going to a traditional debt investment setup, you are largely exposing yourself to corporate. But in corporate parlance also, you will have a good quality corporate, which is maybe a AAA, and a bad quality or a junk quality corporate who is typically a D quality borrower. We said we will get you the prime most borrower, which has a credit score of 700 plus, right? So I'm sure everybody here on the call would have taken one credit card or some loan in the past. They all get reported to these credit rating agencies like CRISIL, Experian, CRIF, and depending on their ability to repay and the intent to repay, they get a credit score between 300 to 900, right? The poor quality borrowers are typically in the range of 300 to 600, and the better quality are upward of 700. We said, can we get you the 700 plus quality borrowers who across a very large time frame have showcased ability and intent to repay, right? Similar to how you can create a AAA debt portfolio, right? You'll say these are safer portfolios, these are better portfolios. But inherently, the problem on the AAA side was not that AAAs were bad. It's just that the lack of diversification would marred you with risk, right? Where a fund manager was only capable to diversify your money across 30, 40, 50 AAAs, right? Because beyond 50 AAAs, no good AAA borrowers. Never a TCS, never a Nestle, never an HUL will ever borrow from the corporate debt market, right? They're cash rich. Good companies like Reliance will reduce their debt, right? So the fund manager inherently will take exposure, which is 2%, 4%, 6%, 8% in one paper, Thereby, if that paper went bust, you lost money. We said, can we not just get you prime, which is inherently 2 levels of safety, which is retail and then prime. And then we said, can we help you diversify in a manner where your exposure even to the best of best borrower is less than 0.5% to 1% of your invested capital, which means your diversification is across 150, 200, 300 plus borrowers, right? So that level of diversification helps you mitigate risk. And that is how we said we'll want to differentiate. We'll want to cater and bring something like a large cap equivalent to the investor, where they don't want to take a risk, right? They want safety. They want to do fixed income, right? If somebody wants to make a very high return, they surely will be happy to take some amount of risk and maybe to go to an equity asset class or a real estate class, right? On the fixed income side, we have goals, right? Beti ki shaadi karni hai. I want to get my daughter married. I want to plan a holiday. I want to buy a house. How do I make a good fixed income investment, which is not volatile, which does not give me M2M loss, which does not impair both my capital and interest, and gives me enough liquidity? We said, can we solve for all of these traditional risks at one go through Liquiloans? And that is what we wanted to offer. And thankfully, we've been able to do this by simply saying, we'll get you these borrowers. But as you rightly said, how do you do this, right? How do you get these borrowers? Why would a good borrower even come to you, right? The idea was very simple. A good borrower never comes to any NBFC first. It first goes to his bank, right? Somebody like you, Gaurav, you will have pre-approved line of credit from your bank saying, sir, loan le lijiye, right? Pre-approved, no documentation. Take 5 lakhs, take 10 lakhs, take 15 lakhs, right? All of them on the call will also have such pre-approved offers, right? Then why would they come to me? They would say, I have a cheapest source of credit from a bank, right? And in the easiest way that I can get it, right? The only way to get this right was follow the Bajaj finance model. Where we said, similar to how a Bajaj would try with a Chroma, a Vijay Sales, an Amazon, and a Flipkart, right? Where they said, come, take a product. I won't charge you a rupee of interest. A no cost EMI will be offered to you if you are a prime borrower, right? I will charge the vendor on your behalf and make an earning through them. We said, let's replicate the same model in safer opportunities, which is education, healthcare, and home decor, right? Brilliant use cases. Somebody wants to do an MBA from Nursing Monji, right? Somebody wants to take an upskilling course from UpDeck. Somebody wants to do a graphic designing course from an AppTech, right? Somebody wants to plan a baby, will go to a top IVF clinic like Nova, Indira, Morpheus. Somebody who's already planned a baby, right? Will go to a live cell and mycord to preserve the stem cell. Somebody wants to decor his house, he'll go to a live space. We have 150 plus vendors that we've tied up with, where we said we will be happy to offer no cost EMI by underwriting prime borrowers, right? And what do you mean by prime borrowers, right? That's the question that everybody has. How do you decide who to give money to? We said the average credit score has to be 700 plus. They should be tier 1, tier 2 situated. Their overall savings have to be meaningfully high, right? Which means if they are earning 100 bucks, they are not spending more than 35, 40 bucks, which is their fixed expenses, including their maintenance, rent, existing EMIs, which means they're saving nearly 60, 65% of their income. And we said, we'll give you a very small 40, 50,000 rupee average loan for an average tenure of 10, 12 months, which means their EMIs are in the range of 5,000 bucks. My average borrower's annual income is upwards of 9 lakh rupees. If somebody was making 9 lakh rupees, and if I give him an average 40, 50,000 rupee loan, that also which he has to pay over the next 10, 12 months, with highest probability, we'll recover that money. And what we've done is we've mitigated risk for you here, right? I'm not lending directly to the borrower, right? I'll give you a quick example for everybody's quick understanding, right? Let's assume a customer and borrower goes to any of the registered vendors with us, somebody like an upgrade, right? If he gets approved, let's assume he's taking a 100,000 rupee education course, right? If he gets approved, he pays the first 20,000 directly to the dealer, which is his skin in the game, down payment, right? After which he takes a loan, and let's assume he's repaying that loan over the tenure of 10 months, right? Which means he's going to repay back 88,000 over the next 10 months without bearing a rupee of interest. So the borrower is always happy, saying, hey, boss, I can take a loan without paying interest, gets crazy payment flexibility. Why shouldn't I not take it, right? If the borrower got that loan, he would be happy. He'll repay back the money via NACH, which is an auto debit instrument, right? Which helps us recover money from him. And if that NACH goes, if it bounces, it's a criminal offense to him, right? If he doesn't repay for 90 days, he essentially will be classified as an NPA, post which cash collection agency will reach out to him and recover those monies, right? And most importantly, for a good borrower, his prestige is very important. His credit score is very important. As soon as he defaults, right, his credit report will start showcasing a comment from us which says willful defaulter. which means his credit score will drop meaningfully. And additionally, no bank or NBFC will ever lend monies to him, right? We said that that is a very big deterrent for a good quality borrower, especially when he can't commit a fraud, because the money for the loan is not coming to his bank account, and nor is he getting a product that he can sell. He's getting a service, right? The beauty is when he took that 80,000 loan, he was going to pay that 100,000 upfront, right? And he said that I'm happy to get this loan. What happens at the back end is we get a subvention or a discount from the dealer, right? Similar to, let's assume, the same app tech example, or upgrade example. Somebody went to upgrade, wanted to take a 100,000 rupee product, paid 20,000 down, took an 80,000 loan, but we would not disburse that 80,000 to the vendor. We'll say, because we helped facilitated the sale, give us a discount, and let's assume that discount was an X%, the discounting rate of 23% IRR, you will disburse the balance to them, and you will recover the full 80,000 rupees from the borrower, which will help us earn a gross level return of 23% plus, right? Similar to how you go to a Chroma. You want to buy a TV for 100,000 rupees, you pay 20,000, took a loan for 80. Bajaj did not give the full 80 to the vendor. He would have discounted, let's assume, by 10%. He would have just given 72,000 to the Chroma guys. Against the 72,000, Bajaj is going to make back 80,000, right? Which is he's making 8,000 over 72,000. That is 11.1% return. And over and above that, the beauty is because the cash flows are regular, right? Every month the borrower is paying 8,000 or 10,000 rupees. The money does not remain idle. It gets reinvested for him to allow the monies to compound, which also helps somebody like a Bajaj to make a 23-24% return, right? So we replicated that model, but in a safer segment of education, healthcare, thereby helping investors not just make a better return without even penalizing the end borrower by asking him to pay some crazy interest, right? I'm saying don't pay any interest, not even a crazy interest, not even 2% interest, pay zero. I will make money directly from the vendor, right? And that portfolio of borrowers will be available for investors to lend to, right? Any questions still here, Gaurav? Happy to delve deeper into some specifics that you want me to touch upon.
Yeah, sure. This is helpful. Can we understand a little bit more around let's say to begin the product side? What are the kind of services these kind of borrowers use? What is the product mix?
Sure, absolutely.
And how do you select these kind of partners?
Absolutely. So what we said is first the partners have to be in business for at least 5, 10, 15 years, have to be having a very healthy balance sheet, have to have a very great performance, have to have load of outlets or have a crazy online presence for us to even shortlist this vendors, right? So we'll not work with a Tom and Pop shop, we'll work with brand names, right? From a Dr. Batra to a Nova IVF to an Upgrade to a Nursing Monji to a Live Space who've been into the ecosystem for long, right? There we said that the people going to these outlets were never credit hungry, right? Somebody who wants a loan will never go to an Upgrade, will never go to a Nova IVF, right? If you and I want a loan, we'll go to the bank, right? Which means the guy who entered these outlets or went to their online websites were not hungry for money. He went there to consumer service, knowing that these services start from 30, 50,000, go up to 5, 7, 10 lakh rupees, right? We said that anybody who enters these outlets, not everybody would be offered a no-cost EMI. We would ask the vendor to offer a no-cost proposition to the borrower. We will pull some details from the borrower's detail. We'll take some details from the borrower, typically his PAN card number, his salary, where is he working, for how many years, which city is he originally from, right? And an approval to pull his credit report, right? As soon as I do that, an algo at the back runs all of this data points, right? In cases where the loans are upwards of 35, 40,000, we pull out bank statements to perfumes, right? It essentially is like an P&L for the end borrower, right? Let's assume I was getting a 100 rupee credit of salary every month, against which my bank statement will also show my expenses, right? Which is my rent, existing EMIs, my maintenance expenses, all of that, which will help me understand what is the leverage that the borrower is taking. Is he spending 90 out of the 100? Or is he expending more out of 120 out of 100 by using a credit card? Or is he just spending 30, 40 bucks and saving 60, right? After a thorough analysis by my algo, it will give a detailed snapshot to my manual underwriter. So these are the pros, these are the cons. Now take the call whether you want to give a loan or not, right? So let's assume somebody took 10 credit lines in the last 7, 8 years, right? He's repaid all of them largely on time, except one scenario where he delayed for 2 days, right? A manual underwriter may miss that, right? But the computer will never do. Computer will say that one time this guy delayed. Now the manual underwriter will take a call. Okay, is one time a good enough exception to give? and still approve that borrower. Let's assume his credit score was 800, right? He's taking a brilliant course from upgrade, right? Where his intention is brilliant. He wants to educate himself because he knows the competition is fierce, right? If you don't study ahead, you might not get a pay hike, you might not get a better job, right? So people wanted to start studying, and thankfully in the last 1 year, right, in the pandemic, you would have seen all these edtech players have not grown by 10-20%. They've grown by anywhere between 100 to 500% because a lot of people were homebound. People started studying more because their visibility of income was bleak, right? They said, let's get better suited to with better education so that when the market opens up, I can do way better in my career. Same with healthcare, right? We said we'll target discretionary healthcare, right? For which you go yourself want to avail that service. It's not a death scenario, or it's not an angioplasty scenario. It's not a knee replacement scenario where you have to get it done and maybe you don't even have the money. I'm saying all of these outlets that I mentioned, Abatra and IVF and LifeCell, you only go when you have the money. It's not a dire need, but it's a desire, right? You have extra money, you will say, I want to do a hair treatment. You want to do a skin treatment, you'll go to a rich field. You want kids, you'll go to an IVF. And all of these have a very large emotional connect with the end borrower, right? If you're planning a kid and if you've taken a loan, in most cases, you'll never default. Same is with the stem cell. You have just a kid born and you are preserving his stem cell through a lifestyle and mycot. There's no large chance that you will default, right? Or somebody doing up their own houses, somebody going to a live space, right? Knows that these charges are anywhere between 2 lakhs to 5 lakhs or 7 lakhs, right? The credit methods to evaluate these borrowers are stringent, and thereby only a zero cost loan is given to these segments where we are saying these good quality borrowers have showcased ability and intent in the past. We are underwriting them prudently and offering a no cost loan where they are incentivized. If I'm getting a loan without interest, I'm happy to take it, gives me crazy flexibility. And at the other end, the vendor gets crazy volumes. So it becomes a win-win, both not just to the borrower, but also for the vendor.
Got it. Makes sense. So you've already covered the borrower selection and the criteria for that. But let's say, how does the typical diversification work? Let's say if somebody is putting in a lakh of rupee in the loan product on any particular tenure or asset, right? How does the diversification work?
So what we said is when RBI brought in licensing norms, RBI said that one investor or one lender can't lend more than 50,000 to one borrower. Okay. Plus the borrower can't borrow more than 10 lakh rupees from a platform, and he can't borrow for more than 36 months. Right. So when the construct started at the investor level also, there were limits up to 10 lakh rupees a pen, which means let's assume Gaurav, you came and invested 10 lakh rupees. As per RBI regulations, you could have diversified across 20 borrowers, giving 50,000 each, which was the max limit, to one borrower, right? What we said is the diversification here is poor, right? If in a debt fund where you had 30, 40, 50 underlines and you still lost money in some of the other scenario, we said we have to go 5x of that. How do we do that? We said when somebody's money comes into the escrow, we will through our algo allocate him a part of a loan that is disbursed to one borrower. Right? They select an auto invest feature where they say that, boss, please assist me. I will want to diversify as meaningfully as possible, where my exposure will be less than 0.5% to 1% in most cases, right? So which means your average diversification is across not 30, 40, 50. It's across 150, 200, 250 borrowers, right? Additionally, what happened is because these loans are repaying back on a monthly basis, right? So let's assume you lent out $100 and $10 came back the next month. Again, that $10 went into new set of loans, allowing you to get more borrowers to get diversified into, right? So with time, your diversification will keep on increasing, whereas your modified duration on the portfolio will decrease, right? Which is the most optimal way to reduce risk. And that is why we said we'll help you, assist you, diversify in such a meaningful manner that you will at no point of time take any concentration, thereby reducing your risk, right? Whereas the borrower also on the other end is retail, it's prime, average 700 plus, taking a less than average 12-month loan. He's taking a very small quantum loan of 40, 50,000. That for a brilliant use case of education, healthcare, and home decor, right? And that helps you to get a very safe exposure plus a diversified exposure in a very safe fixed income instrument, right? In that, you can't have multi-baggers, right? It's not an equity portfolio that 2 stocks out of 5 did well. I'm happy if the other 3 did work, still it's okay, right? In that, you have a limited upside, but you have an unlimited downside. Every time one borrower stops repaying, you lose that proportion of your principal. He said the only way to de-risk this was to have a crazy high diversification. Let's assume a AAA debt. You lost money because diversification was poor. But if you had 300, 400, 500, 600 AAAs that you could lend to, even if a Diwan housing crisis happened, even if an IL&FS crisis happened, you would have not lost much, right? You would have lost maybe 0.5% of your capital, whereas the other 99.9 or 99.5, sorry, is paying back enough and more return, right? So the beauty in that is always through diversification, which unfortunately was not present in the erstwhile models which we brought on the platform.
Got it. Okay, makes sense. So let's probably talk a little more details around risk, right? That's one of the area where our users like to understand most, right? How do you kind of mitigate risk? What's the current NPA, right? And what does it mean? And what is the buffer you have to cover the NPAs? So if you can talk about it.
Sure. I'll run them through details. First, we said this zero counterparty risk, right? When you lend monies in an NCD, right? You're taking counterparty risk. You just went by a brand name. Now, if that brand name is not lending it ahead prudently, you're taking risk on the counterparty, right? If you lend to a cooperative bank, if the bank went bust because of a poor underwriting or bad loans, you don't recover money. Here we are saying you are taking no such risk. There is zero counterparty risk. Right from day one, when RBI started issuing NBFC peer-to-peer license, they mandated all of them to have an escrow trustee setup, which is similar to a mutual fund. Right? So even after the Diwan housing collapse, right, investors in a Diwan housing AMC never lost money, right? Because every fund flow in the securities were through the escrow and trustee. So what we said is whenever an investor comes to invest or lend on our platform, his money don't come on my balance sheets. They go to a third-party escrow, which is owned by the Government of India and LIC, which is IDBI escrow, held at Nariman Point. Okay. Out of which, whenever a loan is approved, all the documents go to the trustee. Once the trustee verifies, approves that transaction, the trustee instructs the escrow to remit the monies to the borrower designated accounts, typically these vendors, right? And when the borrower repays back the money, again comes into a separate escrow held with IDBI, okay? From which we are seeing the first pool of money, which is his capital, and the interest flows back to the investor. And any return over and above that is left in his account will be expensed to us to make our costs, recover our costs and make profits, right? So one, mitigation of risk at the structural level, right? Thankfully, because of regulatory restriction, this is a very safe model similar to how a mutual fund works. Second, we said we will bring industry first 100% alignment, where we are not just saying that make return, we are saying make your return first, where not just get back your capital first, get your return also first. Till that time, I will not charge you any fee, any cost whatsoever, right? In a traditional product, you would have upfront fee and onboarding fee and an expense ratio and transaction cost. I'm saying I'm not willing to earn any of that. You get your capital first, make your return first, and then whatever is left in your account, right, over and above your indicated yields, will be expensed to us to recover our costs and make profits, which means I'm last in line to make money, right? That will be crazy alignment. And I'll run you through the example here, which will give more details and insights. Currently, the gross returns on the platform on all of these loans are 23-24%, right? Across a diversified pool of borrowers. What CRISIL has estimated is an expected range, as we showed earlier, is a range of 1.68 to 2.06% NPA, right? Although my current NPAs are just 0.97%, I'm saying 6x of CRISIL's expected range, right? You will not lose even return. And 13x of that expected range, you will start impairing your capital. Before that, your capital is also safe. And that is how I've shown it through the math down below. Directly, let's go to the right side of the table where we are saying, let's assume somebody invested $100. He's grossing a 23% return. And let's assume a theoretical worst case scenario that on day one, you had a 2.06% NPA, right? Which means you will not make 23 on the 100. You will make a 20.94 now, right? Because you lost 2 rupees, right? Now, out of the 20.94, will the investor earn a first come first? The highest yielding product that we have is 9.5%, right? The popular option that a lot of your investors invest into. It's a 1-year product. Will the first 9.5 out of a 20.94 go to the investor? Does he, in that scenario, lose money? The answer is no. Let's assume the NPAs was not 2, it was 4, it was 6, it was 8, it was 10, it was 12, right? The net return would have fallen down to 10.7, okay, in a 12% NPA. but still the investor makes his first 9.5, right? Now look at the scenario from my angle. If the NPS keep on increasing, right? Who's taking the impact of that NPS for you? Is essentially Liquiloans from the potential fees that they were to make, right? If the NPS was just 2%, you made your 109.5, the balance was expense to us to recover our costs and make profits. If the net return was 18, we now made 18 minus 9.5 versus the earlier case of 20.9 minus 9.5, which means every time the NPA goes higher, it impacts us first, right? So now I'm running a business. I surely want to recover costs and make profits. This is going to bring me crazy alignment where I'm saying that I have to ensure the NPAs remain low so that at all points of time, not just the investor gets back his capital and return, we also make meaningful money to recover costs and profits. We are one of the first peer-to-peer NBFCs in the country to be profitable. Happy to announce that to you, right? Where we are saying in the last 4 years, everything that could go wrong on the debt side has happened. A D1 crisis, an ILNFS crisis, a pandemic situation. Even after that, we don't even have one investor who has even lost 1 rupee of interest, right? That is what investors want. Even in the worst time, something like a 7 sigma event of pandemic, I should not even impair my capital nor my interest. मुझे पूरा ब्याज, पूरा capital बनते रहना चाहिए. Liquidity मिलते रहनी चाहिए, right? That is what we have delivered till date. And as you rightly questioned, what's my NPA? Currently it's 0.97. But the more pertinent question is, what was my NPA in the pandemic period, right? Did the NPAs go off the roof? No. My highest recorded NPA till date, including the pandemic period, was recorded in October of 2020. And the number was as small as 1.63% on a gross level. Net NPAs are even lower, right? Which means even in the pandemic time, until today, no investors lost money, neither capital nor interest, right? And that's purely business of the alignment that we have provided since day one, right? Because we said we don't want to make any upfront fee or expense ratios from you. Let the product be meritorious so that it helps you to get back the return on capital and helps me also make enough money, right? And then we said it's not just that we provide this, we also provide details to the end investor. How well his portfolio is diversified, across how many borrowers, what are the type of borrowers, what is the income of the borrower, right? All of these details are provided for him to get transparency. Then what we said is in the fixed income side, not just the return and the liquidity is of prime importance. There are other risk factors that you need to mitigate. And across traditional set of products, be it fixed deposit, be it bonds and entities, be it debt funds, where are we placed, right? These are surely in terms of returns are meaningfully higher, starting from 8.15 to 9.5%. Liquidity was even catered in the worst of March, April of 2020 when there were two lower circuits, right? People panicked, people wanted to move out money and then go back to equities, right? People who withdrew back then, they also got back their money in T+2 working days without a rupee of loss. Maybe that some of them put that money in a liquid fund and lost money because liquid was a negative return, right? Third, we said alignment is necessary, right? Why are these guys filling up their pockets first and then leaving your fate to the end borrower, right? Typically debt funds. NPI, they'll say, we'll reduce the NAV, pass on that loss to you. But I would have made enough money through expense ratios. I'm saying that's not going to work. Today's investors are going to be more intelligent, more prudent, will want alignment. And that is what we're bringing on the table. Fourth, we said inherent credit risk is lower because the quality of the underlying is better. When I'm saying the biggest banks are losing money with corporates, then if you are also doing corporate exposure via debt fund or an NCD, you are having a poor exposure. If inherently you are retail, plus you had a safety net of prime retail, plus you had these borrowers who are not needy and greedy, they were taking a no-cost EMI, the underlying was 5-10x safer than what you were doing earlier. Fifth important piece is interest rate risk, right? Not many people understand this. When liquid funds were yielding 6% 2 years back, today they're yielding 3%. Debt funds were yielding 8-9%, today they're yielding 4%. Why did this happen? Because the interest rates in the economy fell down, right? Inherently, underlying portfolios were not yielding you as much return as they should or they would have given in the past. But in my portfolio, there is no such interest rate risk. Let's assume you invested into a 24-month product, right? Which you offer to your investors, yielding 9.3% annualized. Now let's assume the interest rates halved. Even when half of that, still the investor is making his 9.3. His return doesn't go down. And that is what the investor wants, visibility. That is what we are providing. Inherent asset class was safer, and that's why your risk-adjusted returns was meaningfully better when you invested via Liquiloans. And these are again the broad numbers that you wanted to see, right? You've disbursed more than 500 crores with a gross NPA of sub 1%, industry-leading gross NPA, one of the lowest, right? More than 150,000 borrowers that we have lent to. more than 11,000 investors who have trusted us. Plus, their trust is not when they came on board, they also renewed capital. 88% by value have renewed. Gross yields of 23% plus. All withdrawals, all payouts. Whenever somebody asks for even a monthly payout, has been honored by 100%. And very few people can write this down in black and white, right? A performance of 100%. No investor has lost money, neither their capital nor their interest till date, even after the pandemic. And that's the number that people should look at, right? Safety. We are doing fixed income. Plus, inflation beating better returns. Giving you a quick snapshot of our milestones. We got the license, RBI up the limits to 50 lakhs of PAN. We now take 50 lakhs across a PAN card. So even an HNI could put in 1 crore, 2 crores, depending on the number of PANs that he has in the family. Even in the quasi-liquid product, which is yielding 8.15%. Your traditional liquids are just giving you 3%. We were the first ones to get invited by the RBI on the expert working committee to advise the RBI on the digital lending framework. So we were there. It was Google Pay. It was Paisa Bazaar, right? The only licensed agency in the country on the peer-to-peer side was Liquiloans, who was invited by the RBI. And recently in June of 2021, we've also got one more NBFC license, which will help a lot of HNIs to even scale up their investments with us. Somebody wants to do 5 crores, 10 crores, 15 crores in the future. Through a better NCD or a nuanced structure like an MLD, we'll be offering that to investors. Right? So inherently, what should investors want? They want an uncorrelated asset class, because if equities and debt markets go up and down, I don't want to face volatility. I don't want to lose my return. This is the product that gives you uncorrelated exposure, a safer exposure, which reduces inherent risk for you with complete alignment, where I'm putting it in black and white in every investor's agreement that you make your capital and return first, after which if there is something less, that is going to me. That's why we have a 100% success rate.
Yes, with this, we've come to the end of our session. And to everyone who attended, I hope you now have a deeper understanding of P2P as an asset class, Liquiloans as a brand, and of course, all the plans that Cube offers to its users in partnership with Liquiloans. So do check out the latest plans on the Cube app, look at the minimum holding period, contact your wealth coach if you have any other questions, and we'd be more than happy to help. So yeah, thank you once again for joining us on a Saturday morning, and have a wonderful weekend.